Welcome to the chat where the deals get done. Real estate tips and a whole lot of fun. Think different, achieve your goals. Real estate simplified, that's how we roll.
Good morning. Welcome back to Real Estate Simplified. I'm Mike Cruz here with Brandon Rizek. And we are here to cover all things real estate for you. So going to go ahead and get into it. Talk about a little bit of the market, see what's going on here. Our inventory here in the Las Vegas area has been on the rise. Total inventory is just under 10,500 at 10,466 as of this morning. That includes single-family homes, townhomes, condos, as well as high-rises and even manufactured homes. So that number 10,466 seems a little high, and it's definitely a lot higher than it's been. The good news is while inventory is still going up, the rate that it's going up at seems to have peaked, and it's rising a little bit slower now. So that's a little bit of good news. Let the summer market absorb some of those sales.
Yeah, you don't want the inventory to rise too much, too fast. I think that's what Mike's trying to say is that, you know, inventory can be higher. It can be in the 10,000 range. No problem with our population, right? But I'll let you get into that. But at the same time, too much too fast could mean bad news.
Exactly.
But if it's steadily doing it, we're okay.
Right. Okay. Now, the buyers, you have lots to choose from with 10,500 homes on the market. But the inventory, it's meaningless unless you compare it to the number of sales out there. So sales in the last 30 days here in the Las Vegas Valley were 2,770. That's actually a pretty healthy number. So with that said, when you figure that sales number in with the inventory, we have about 3.8 months worth of inventory. So a little under 4 months of inventory on the market.
Okay.
That's not a bad number. That's a nice, even market.
That's actually good for buyers.
Absolutely. Yeah, it's great for buyers.
It's great for buyers. So we're
Plenty
starting
to
to
choose
shift.
from.
You know, we're starting to shift to where if you're a first-time buyer or you're a buyer in this market, you're sitting pretty, I think, you know.
Buyers are out there, they're getting concessions from the sellers. Sellers, a little bit of bad news. I think you missed the top of the market for this go-around.
And it could be temporary. We don't know that, right?
Absolutely, yeah. I'll be the first to admit my crystal ball's broken.
Yeah, I know. We wouldn't be here if we had crystal balls, right?
Exactly. But yeah, definitely seeing more price drops in the market and concessions. So getting closing costs paid for buyers is definitely a thing right now. Interest rate buy downs, stuff we've talked about over the last few weeks, really coming into play for a buyer. If you're a first-time home buyer, it's a great time to buy. You're getting some incentives to soften the blow of the higher interest rates. So,
well, you know, it definitely does help stomach, you know, paying the high sixes or whatever in your interest rate. You know, when the interest rates really, they creeped up a tiny bit since our last episode, but then since then they're actually starting to creep back down.
Okay.
So we are starting to stabilize just to, you know, again. So we've been pretty overall level. I mean, here we are at the very end of May 2025, and we started these podcasts, about a month and a half ago, 2 months ago, and we're pretty close to where we were.
Where we started, yeah.
And I've been preaching stability, and guess what? We're starting to see that trend happen, which is good.
Yeah, and we're seeing it in the market too. That's what that inventory number means of 10,466. And for those of you that have been in Las Vegas for a long time, that number seems really high, but you need to remember our population has increased. The number of homes being built has gone through the roof, and builders are still building. So
that's always a good sign. So in my experience, and I'll let you elaborate on this, but if you know, the builders are smarter than us.
Right.
That's the way I look at it. They're just smarter.
Yeah.
And they've done their research. They know what's coming. They project, 5 years down the road.
Yeah.
And if they're still building homes and they're still buying land up, then that tells me that there's nothing to worry about.
Right.
In my opinion.
No, absolutely. And just a couple little fun facts when I was running the numbers this morning for inventory. The most expensive home currently on the market here in the Las Vegas MLS, $32 million.
Wow.
Who would have thought we'd ever see a home listed at $32 million here in Las Vegas?
Wow, that's Los Angeles prices there,
Right?
man. New York prices. Wow.
Yes, and the least expensive is at $180,000.
That's the least expensive?
That's-
Actually, I thought that's a little higher than I thought it would be.
That is the least expensive single-family home, and to be honest, kind of looks like it's probably a teardown.
Yeah.
Yeah.
That's a single family, not a condo?
That's a single family, not
Wow.
a condo. Yeah. Condos you can.
To
get
our viewers,
in the
I'm
lower-
sorry. To our viewers, you are not buying that home.
No.
It's
not
gonna let you
financeable,
do it.
it's cash
I'm not
only.
letting you do it. So.
Yeah, it won't qualify for financing.
Yeah.
And the number that really caught me is the number of homes listed at $1 million or more. 1,167 homes here in the Las Vegas Valley listed at $1 million or more.
Wow.
So if you're in that higher range, you still have a great choice to choose from.
You know, if you're from California, you're from Oregon,
Right.
Washington, Seattle, these numbers don't mean anything to you. But if
No.
you're from Las Vegas and you've been here 10 plus years,
Right.
those numbers are pretty big,
Those are
man.
huge
I mean, we
numbers.
didn't see $1 million homes 6 years
Right.
ago. I mean, you were
Yeah.
buying the big custom home, guard gated community,
Right.
4,000 square feet. I mean, you were buying a big home. In today's world, that number's been up and up and up. So, 1,100 listings over $1 million. That's just insane to me. You know,
Right.
being here as long as I've been. So,
Yeah.
you know, and that kind of ties into. Oh, I'm sorry. Do you have more?
No, that's-
more fun facts. 'Cause I like
No,
those
that-
facts.
that's-
Those
that's
are
all I
awesome.
have.
All right, man. We need more, Mike.
Yeah.
No, it just brings it into you know what happened. Why did we go to the 1 million? What happened? You know, where did the 1,100 properties at $1 million come from, as opposed
Right.
to 300 listings at $1 million?
Right,
You know,
well-
and was it COVID? Was it since then? Values have spiked.
Big part over the way, and it wasn't even just around COVID, it was even pre-COVID. The interest rates were so low for so long that it continuously has driven the prices higher. And unfortunately,
demand.
The demand's been crazy, and the affordability has kind of gone out the window. And it's not a Las Vegas problem, it's a nationwide issue.
Yeah.
It really is. Couple markets are seeing some decent corrections. I know a few cities in Florida, as well as Austin, Texas, definitely seeing some correction. But overall, the affordability, it's gotten tough for first-time buyers.
Yeah, but I mean, rates, affordability got tough. But let's just put this in perspective,
Mm-hmm.
okay? Vegas, Austin, the markets you just talked about, and parts of Florida, right?
Right.
So let's say it's Tampa, because I'm going to go. That's probably pretty close, or Orlando, or those kind of
Right.
markets in Florida, right? So, but these are fairly new markets.
Right.
Okay, look at LA, look at New York, look at Michigan, look at Ohio, look at these, states and cities where they've been established for hundreds of years. The
Yeah.
population increase happened there in the early 1900s,
Right.
not in the early 2000s. And I just think this is growing pains for
Yeah.
Vegas. I think it's growing pains for Austin because we got so hot so fast.
Right. Well, right.
And that doesn't scare me.
Yeah, no, and it's not a nationwide market going down issue, because I
That's what
can
I
tell
mean.
you the upper Midwest, Chicago, most of Michigan,
Cleveland is where I'm from.
I was going to say the entire Northeast, they're still in bidding wars.
They're in bidding wars.
Yeah.
Even
And
with these
houses-
interest rates, and even with, their tax rates. Like, I'm
Right.
from Ohio. Their tax rates are triple, quadruple
Right.
what they are here, and they're still in bidding
Yeah.
wars.
And these houses, they're not bidding wars 10, 15,000 over. They're hundreds of thousands of dollars over.
So to summarize, I really do, I do think that these are just growing pains
Right.
in cities like Las Vegas, Austin,
Yeah.
cities that have boomed kind of overnight,
Right.
so to say.
And overall, the economists do predict prices rising for the year.
Well, that brings me to my next thing. So, Fannie Mae, Freddie Mac, Ginnie Mae, they're called the GSEs, Government Service Agencies. They have predicted rates by the end of 2025 to be in the very low sixes on a conventional loan. FHA will probably be lower.
Right.
They've predicted by the end of 25 to be in the very low sixes, maybe 6.1, somewhere in that light. And then they predicted by the end of 2026 to be in the high fives.
Wow.
And they also predicted with that, we're going to project trillions more in sales, even
Right.
with what we're just talking about.
I've heard the same thing. They say as soon as rates dip below 6.5, the inventory is going to drop, prices are going to go up, and we're going to be right back to where we were over the last few years.
Okay, so let's talk about that because that's a key point. Inventory, so rates go down. We expect trillions more in sales. What does that do to our 10,500 listings?
It's going to go down. And you say, but why is it going to go down? Maybe more people will want to sell. The reason it's going to go down is as those rates come lower, a whole lot more people are going to qualify for a home in the first place, or if they're already looking, they're going to qualify for more home. So bigger homes, and it's just going to make the market tighter overall.
It brings more buyers in the market. So
Right.
it brings people in the market that normally wouldn't be in that market. So, and not just in the market, let me say. So, you know, instead of being pre-approved for a $400,000 loan today, this is a key factor. People just think people are on the sidelines. No.
Right.
A lot of people want to buy the $500,000-$600,000 house, but the payment's just a little too high with interest rates.
Right.
But let's say if interest rates go down 0.5%, well, now you're pre-approved for $400,000. Rates go down 0.5%. Now you're pre-approved for $500,000 because that payment just saved you $300 a month. So the point is, I'm not sitting to wait on the sideline because you might pay more for the property anyway. But the point is that it's not a willingness to buy.
Yeah.
The point is that a lot of people have been pre-approved. They just can't get what they want at that
Right.
price, and it brings more buyers into the buying pool, or raises the current buyers in the buying pool's qualifications.
Yeah, the bottom line is just yesterday I told a client, he asked me if it was a good time to buy. I said it's a good time to buy when you can afford to buy.
Yeah.
And we've said that before on here. If you
When
can
it's right
afford-
for you.
When it's right for you, that's when it's the right time to buy.
And you know, especially if you're selling to buy, a lot of
Right.
people don't realize this. Okay, if you're a first-time home buyer, disregard this. Okay, but if you are selling a home to buy a home, you're interested in doing that. Everybody says, well, you know, there's more listings. I might not get what I want for my property, or I missed that top of the market, like Mike just mentioned. Okay, but wait a minute. You got to buy a house. Okay,
Right.
so what happens is if you sell 10,000, 20,000 lower, you're also buying 10,000 to
Right.
20,000 lower. So it shouldn't discourage anybody by any means. It should equal out. And that is something that I think people don't realize. There's a short-sightedness. They don't realize, okay, yeah, I had to give my property away for a deal, but you're probably going to get a deal on the next property too. So, you know, it should equal out and it shouldn't discourage you. So that's why it goes back to what Mike just said. Buy when it's right for you.
Right.
You know, when is it a good time?
Absolutely.
When you feel it's a good time, when you think it's a good time.
Absolutely, yeah. If you need that bigger home, don't say I'm going to wait a year. If you can make it happen now, there's no reason not to.
Well, waiting a year, okay, so what happens? You
Right.
know, if rates do go down to
Rates might go
6.1.
down, but have prices gone up? And
will.
now you're going to pay the same price versus if you were to buy now at the higher rate. Yes, if rates go down, you can refinance and then get the lower payment and take advantage of the whole situation.
Yeah, in theory, of course.
Right. We can never guarantee rates are going to go down. So,
Right. But, you know, let's talk about what's happening politically. I'm not going to get into politics. I
Right.
don't mean it that way. That's not what we're about here. Politics and financial markets, I'm going to go over that in a minute because they coincide, but at the same time, they hate each other. So,
Right.
and we're strictly financial here. So, but what happens, you know, with what's going on in the economy, the politics and everything, and you hear Jerome Powell, the chairman of the Fed, you hear all these things, and when are rates coming down, or, you know, you hear Trump tweeting, you're waiting too long, or whatever it is that you guys might be seeing on the news, and we all see on the news, okay? So, you know, what happens if the Fed does lower rates? What does that do for our markets, or how does that coincide with mortgage rates?
well, right. And I know you're one to always tell me just because they said the rates are going down doesn't mean they're going down. They went down last month.
Yeah.
So-
okay. So this is
Kind of explain how that works,
okay.
if you could.
I'm gonna try. I might lose people. I don't know, but I'll do my best. So the first thing I've been preaching, if you've been watching or seen any of our previous podcasts, stability. Stability, stability, stability. So this is what I just said. Financial markets and politics hate each other. Financial markets want politics to get nothing done. They want a split Congress. They want a split presidency with the judicial branch. They want everything split. And the reason, it's not because it's conspiracy or anything like that. They want it split because things can't change. It's very hard to pass bills or change big, dramatic things when there are splits in our legislature.
Right.
Okay? So that means that they can predict what might happen. Stability. Well, right now, we have a lot of Republicans in power with the last election. And again, I'm not getting into politics, but financial markets hate that because they can't predict what's going to happen.
Right.
We couldn't predict the tariffs. We don't know. We knew he was going to do it, but we still don't know the effect of the tariffs, the long terms, the short terms. Is it good? Is it bad? Nobody knows. So stability. That's number one. Once we start seeing that, that will help bonds.
Right.
Okay. Interest rates, mortgage rates are developed from the 10-year Treasury. That's the best way to look at it, okay? And when more people buy Treasuries, the 10-year Treasury, rates go down, mortgage rates go down. When you sell off the Treasury bonds, okay, that's when rates go up. So it's very simple, okay? You want to buy a bond, and there's a yield on that bond, right, Mike? So
Right.
stop me if you don't follow. You want to buy a bond, and they're offering a 4.5% yield or return on your purchase, right? Well, if a bunch of people are buying bonds, they're going to lower the yield. They're not going to pay as much interest because now buyers are a dime a dozen, right?
Right.
Okay, but if people are selling off their bonds, they're going to raise the yields
Right.
to entice people to buy
Absolutely.
them.
Yeah.
So when the Fed lowers interest rates, this has nothing, and I mean no offense, it has nothing to do with mortgage rates.
Right.
Mortgage rates are derived from the 10-year Treasury bond. So a lot of times what happens is the Fed are lowering rates, people start selling their bonds. Because
Right.
now the rates are going to
now
be
the-
lower than they're being offered.
Right.
So what happens is everybody calls and says, oh, I heard the Fed lowered the rate 0.5% or 1/4%. Where's my mortgage rate? No, your mortgage rate actually goes up when the Fed lowers rates. Now that's temporary. I don't want to scare people. It's
Right.
temporary.
And a lot of times I know the mortgage rates might fall just before the Fed does a cut.
Because they have the smart investors, so to say, and the people who are all in this and day trade this, they know the dip is coming, so they'll start either buying or selling or whatever it is. So that happens, the projections, it's already priced in. Then the Fed does the actual lower and people sell off,
Right.
sell off. But it's temporary. People will go in and back buy them again. So initially, I know I'm losing everybody, but initially if the Fed lowers rates, generally mortgage rates do go up.
Right.
But it is temporary. They will eventually come back down. Okay. Go ahead. No.
But at the same time, waiting for the rates to come down, in my world, with prices going up, when rates come down, once again, is it really a good idea to wait? So you may want to buy now and then take advantage and refinance when the rates do go down.
I even if you can't refinance up front when the rates go down, generally rates don't go like this, like this, like this, like this. They usually, I mean, aside from a COVID situation or something, rates gradually do these things. I mean, it is not spikes.
Not a night and day
So
type of
even
thing.
if you can't initially refinance right away, you got a 6.5 or whatever it is, and the rates go down to 5.5. Generally, if they're at 5.5, they'll probably be there for a while,
Right.
and you'll be able to take advantage of that eventually.
So it's
you
not
know.
like day trading. You
No.
don't have to jump in and refinance today and
You know, you're in this loan. Generally, most people do 30-year loans. I mean, you're in this loan a long time. I
Yeah.
mean, you know, as long as you're okay with the first payment, you know, just know eventually you'll be able to get it lower. Eventually, you know,
Right.
whatever happens. So I don't see that as something that would deter me, or say, oh, wait for rates to go down. If you can't afford it, you can't afford it. That's the simple thing. But if you can't afford it, buy. And then when rates do go down, or when you can refinance, just do it. I mean, essentially, your value should be holding. Real estate, going back, is a tangible asset. So you're putting your money into something.
right.
no matter what. So,
Well, I appreciate the explanation. That makes good sense
It
and
was-
a little understanding on the interest rates.
it was absolutely in a very, very big nutshell. That was a
Yeah.
very, very tough summary to do. I don't know, but
We're good. Got a couple questions here that we've been asked. Are short sales and foreclosures a better deal?
I'm going to let you answer
yeah,
that because
you
I have
know-
my opinion, and I know yours is
So-
probably right.
It's probably the same opinion.
So,
It used to be back in the 80s and even the 90s when you saw short sales or foreclosures were bigger back then. Yeah, the banks just wanted to unload properties and you could go in, get a great deal. Well, the Great Recession kind of changed that. Banks wanted to get every penny out of every house because there were so many that were available. And they realized, you know what? We can actually do okay with this. We can sell for top dollar and get every penny out of every house.
or market price, you should say, not top dollar.
Market price. It's always market price, whatever somebody's willing to pay.
Right.
But with that said, foreclosures and short sales are not the great deal they once were.
No.
Because the banks realize they can get more money for them, they're going to sell them at market price. And typically, you don't always know what you're getting when you're buying a foreclosure because the bank doesn't know anything about the house problems they had. There could be issues that are underlying that you have that can't be disclosed because nobody selling the house knows about it.
Well, you know, there's a lot of information out there, okay? And I'm slouching, I shouldn't
Yep.
slouch, but there's a lot of information out there, and banks aren't stupid. They're
Right.
not stupid. They pay a lot of smart people to help them, right? And they have attorneys, they have a lot of things, right? So they're going to essentially hold on to that property.
Right.
Hold that foreclosure till either the time is right or they have done their diligence and know what that property really is worth, market price. What is that market price? And that's usually what they put it out there for.
Yes.
You know, they're like the only difference in my opinion between, I'm not going to go into short sale, I'll let you do that, but foreclosures, the only difference is you're buying it from a bank, not a person.
Right.
But there's really no price difference. There's no
they're-
big break there because the banks aren't stupid. They're not going
Right.
to throw away 50 grand.
No.
They're not going to do that, especially when they're losing money already.
Yeah. The big difference with the foreclosure, you're dealing with corporate bureaucracy.
That's it. It just might take longer.
Yeah,
That's it.
exactly.
It takes longer to get an answer.
And a short sale is basically the exact same thing. The seller does have to do the disclosures with a short sale just like they would with a regular sale. But the bottom line is with a short sale, and what a short sale means is that the seller owes more on the property than the market value and what it's worth. So the bank has to approve the sale. The bank has to be willing to take that loss in order for that sale to go through. So there's quite a process in getting that approved and all of that good stuff. Take anywhere from 3 to 6 months for a short sale to go through. So as a buyer, you need to have extra time on a short sale.
You've got to be patient. And
Luckily, in our current market, there are not many short sales. Most people bought when prices were lower and they're able to sell at a higher price, get some equity out of the home, and we're not seeing many short sales. There's a few foreclosures out there, but not many of those either.
Oh,
right
I
at the
saw a
moment.
stat. I mean, there's a lot of doomsday people out there
Right,
on
yes.
on social media saying, "Oh, foreclosures are up and all these things are up." Look at the fine print. Believe
Right.
me, foreclosures are way lower right now. The default rate is way lower than it was in the last 20 years. I
Right.
mean, it is very low.
It's very low.
Very low. Don't let anybody fool you on
Right.
that.
And the bottom line is the banks, they don't want to take the house back. They want to work with the property owner. And if you happen to be a property owner where you're having a hard time making payments, talk to your financing company, talk to your mortgage company. They'll work with you.
Yeah.
The bottom line is as long as you're communicating with them, you're going to be able to work something out and the house isn't going to go into foreclosure.
Put this very simple as a lender. Banks are not in the real estate business.
Right.
They are in the lending business. They do not want your home. People think, oh, the bank wants me to default. They'll get all this. No, they don't want you to. They want your interest and they want it over time. That's what
Right.
banks do. They're lenders.
Yeah.
They do not want to own your home. It costs them way more money to take the property back. They have attorney's fees. They have they have so many fees and everything else that they have to do. They don't want to go through that.
Right.
They want you to make the payment. So there will be a program. They will work with you. The last resort is foreclosure in their head, in their mind. So it's a lot different than it was 15, 20 years ago. A lot different. So
one other area we get, and this kind of goes hand in hand with the short sales, is assumptions. Doing an assumption loan. And
is it a good way to buy?
is it a good way to buy? It can be. It depends on what the situation is on that house. Yeah, they might have a 2.5% interest rate, but let's say you're buying a house for $500,000.
Mike, I'm going to stop you. I know you're in thought, and I don't mean this, but what is a loan assumption?
Thank you.
Let's go through that because somebody might not know that.
A loan assumption is when you're taking over the loan of the current owner of the house and you're buying the home, you're assuming their mortgage.
Correct.
So let's say, for example, $500,000 home. The person that bought the home and owns the home currently, they only paid $350,000 on the home. They've owned it several years. Their mortgage, now they only owe $250,000. Well, in order for you to...
And it's at 3%,
at
let's just say.
3%.
Which is an awesome rate.
Great rate. There's a catch.
Yeah,
That
because they say
catch
it's
is-
a buyer.
Right.
They say as a buyer, okay, I want that 3% loan. And the seller's like, hey, come take it. I don't care. Buy
Yeah.
my house for $550, whatever that number you just threw out, right? Buy my house for $550. You can assume my mortgage. I'll give you the time to do it. We'll figure it out. You can keep it at 3%. And you only owe, what was it, $250 in your example?
Yeah.
Well, and Mike, I'll let you get in the caveat, but where's the difference coming from?
Well, exactly. Somebody needs to pay that difference between the $500,000 you're buying the house for and the $250,000 that is owed on the current mortgage at 3%. That has to be paid in cash, guys. You can't finance that. Unfortunately, there's no second mortgage out there that you're able to take on an assumption purchase.
So to break that down, in Mike's example, you have a
$500,000
$500,000 purchase price.
So like half.
The seller owes $250 on 3%, and that 3% at $250 sounds awesome. Your payment
Right.
is nothing, right? It's very, very low, but there's a gap of $250,000 in that purchase price that you can't finance.
Right.
So a loan assumption is great if you can afford to do that. But a lot of people don't have 50% down or whatever that number might be to put on the down payment. Now,
Right.
if you're a buyer and you have a big chunk of money down, take advantage of it. Believe me, it is awesome. But if you're not putting that kind of money down, I don't know how you're going to be able to take advantage
Right.
of that.
Now, there are a few exceptions to this, and not necessarily in how it works, but I have discovered over the last month or so, few months, there are some people that bought at the height of the market in just before prices dropped a little bit back in early 2022, that bought in that time frame where they have a mortgage where they don't have a ton of equity, but they have that great interest rate.
Yeah, there's still maybe a 4% rate or whatever it was.
There
right?
is some opportunity there to where you don't need a huge amount of a down payment.
Mm-hmm.
You might need 10 to 20%, but
Not 50.
not 50%.
Right.
So don't totally throw it out. There is the possibility you might be able to find that. Just it's not every situation.
It's something that I'll recommend. You got to go case by case, property by
Right.
property, and you have to talk to your real estate or lending professional about this and
Right.
just get clarification on this. But it's just something we're touching. We're touching just the surface. I mean, there's more to it, but obviously it is a great way to buy, but expect to have a big down payment.
Right. And once again, the purchase takes a little bit longer because once again, the bank that has the mortgage currently has to prove you as a new borrower. And unfortunately, it's not as quick as just going out and getting a new mortgage. They really scrutinize the buyers taking over an assumption mortgage.
Yeah, it's about a 60-day process. from memory.
I've
Maybe
even discovered 90 days. Yeah. So that's about where that's at on assumption mortgages. And not every house qualifies for an assumable mortgage anyway.
Right.
So yeah, it really is case by case. Once again, having a great lender and a great real estate agent working on your side to really dig into it and see if it makes sense for you.
Yeah. And
So
guys, in the, just ask away. We'll address any questions you might have. We try to pick, a few here and there, but if there's something that you would like us to talk about or a specific topic, please ask away. And please remember to like and share and
Yeah, subscribe, give us
Subscribe.
that thumbs up. It is absolutely free to you, but helps us get more viewers through the social media channels, and we appreciate you watching, listening, however you're taking us in. Have a great day.
thank you.
Welcome to the chat where the deals get done. Real estate tips and a whole lot of fun. Think different, achieve your goals. Real estate simplified.